Okay, let's take a look at the accounting rate of return. And it's the return on average investment. So the accounting rate of return focuses on annual income instead of cash flows. So we're in the chapter looking at capital budgeting. We've looked at the payback period, and now we're looking at another tool to evaluate capital expenditures. And this one is known as the accounting rate of return. And here to calculate accounting rate of return, we take the annual after-tax net income and divide that by the annual average investment. So you're seeing a couple of annuals here. Let's talk about what this is. For annual average investment, we're looking at beginning book value plus ending book value, and then we divide that by 2. Why? Because if you think about your net income, the net income is on the income statement, right? So it's on the income statement, whereas investment, it's on the balance sheet. And so the time periods are different. On the balance sheet, we have the period as of December 31st, 2015. So that's only for one day. Whereas on the income statement, it's from it's from January 1st through December 31st of 2015. So you're looking at a whole year. And to kind of get to that same number, we take the average annual investment. So we're comparing apples to apples here. So we take the annual after-tax net income, divide it by the annual average investment, and that will help us obtain the accounting rate of return. So now that we have the formula down, let's return to our original example of Fast Track. So there's an investment of $16,000, and the annual after-tax net income is $2,100. So what I'd like you to do is compute the accounting rate of return. Okay, so start off with your formula again. Accounting rate of return, write it down in words, is equal to annual after-tax net income divided by annual average investment, which is beginning book value plus ending book value. And let's discuss what book value is. Book value is simply how much did we buy this asset for less the accumulated depreciation. So book value is equal to the asset less accumulated depreciation, okay? And that will give you your book value. So we have that as book value. So now let's plug this in. So we want annual after-tax net income. And in order to get that, we've been given it. It says it's $2,100, but let's also take a look at how did we get that number. So we know the net cash flow was $4,100 and the depreciation is $2,000. How did we get the depreciation? If you remember, depreciation, the asset is $16,000, right? And then we're dividing it by 8 years. And that will give us $2,000 per year. Now that $2,000 per year, we'll have to consider this in a little bit, but that $2,000 per year, is there a cash impact? There isn't a cash impact, so just try to remember that. So depreciation is $2,000 per year. And after 8 years, the asset has been fully depreciated, so the book value then would have a value of 0. But currently, we're going to purchase it, and the asset will have a value of $16,000 when we first purchase it. Okay, so what are the numbers here? We take the $2,100 and we're dividing it by the 8,000. So let's go back again. Average after-tax net income. So the average after-tax net income we were given was $2,100. And then the annual average investment. Well, wasn't the investment $16,000? So why is it the average annual investment is showing up as 8,000. The reason for that is this is the average annual investment, 16,000 at the beginning of the year plus 0 at the end of the year. Divide it by 2. So that's why we have 2,100 divided by, so you've got 2,100 divided by 8,000, and that gives us 26.25%. Okay, and again, these are both dollar signs, so the dollar signs cross out, and it's a rate of return. Usually most rates are in percentages. So the rate of return on this investment is about 26.25%. Okay, and to determine is that a good number or a bad number, you have to look at what is the rate of return on other projects similar to this, and in general, what's the rate of return on investments. Okay. Now, just like we had in the other tool, the payback period, the accounting rate of return, there are also shortcomings. Okay, and so what are the shortcomings or disadvantages of the accounting rate of return? Well, it bases the amount invested on book values. And as we said earlier, what is book value? The book value is simply, the purchase price. So it's your purchase price less your accumulated depreciation, and that will give you your book value. Okay, but that's not market value, and that's important to realize. Book value is not the same as market value. It simply this is what you purchased it at less accumulated depreciation. Okay. Another disadvantage is income may vary from year to year, and of course it ignores the time value of money. So these are some of the shortcomings of the accounting rate of return. So whenever you use any of these tools, you should realize what are the advantages, how do you use it, and what are some of the disadvantages of using it. And that ends our section on the accounting rate of return.